Ever pondered about the recent surge in US Treasury yields and speculated what it implies for the economy? Well, you're not alone. These yields are a crucial cog in the global financial machine, and understanding them can help us make sense of the broader economic picture. So what exactly are Treasury yields? In simple terms, they're the return on investment for US government debt instruments like Treasury bonds, notes, and bills. When you buy a Treasury bond, you're lending money to the government. The yield is essentially the interest rate that the government pays you for that loan. But Treasury yields aren't just about how much you can earn from a government bond. They also serve as a barometer of investor sentiment. When investors are confident about the economy, they tend to buy less safe assets like bonds, which drives yields up. Conversely, in times of economic uncertainty, investors flock to the safety of bonds, pushing yields down. So why the recent rise in Treasury yields? A few factors are at play here. One is the anticipation of the tapering of Federal Reserve asset purchases. As the economy recovers and the need for stimulus decreases, the Fed is expected to buy fewer bonds, which could drive yields up. Another factor is the concern about a potential US government debt default. When the risk of default increases, so do yields, as investors demand a higher return for taking on that risk. But it's not just about domestic issues. Global factors like inflation and economic growth rates also play a role in Treasury yields. For instance, recent data showing increased consumer spending and accelerated factory activity have led to speculation that the Federal Reserve may tighten its monetary policy sooner than expected, which could also push yields higher. Understanding Treasury yields is crucial to comprehend the broader economic picture. They give us a glimpse into investor sentiment, future interest rate movements, and the overall health of the economy. So the next time you hear about Treasury yields in the news, you'll know exactly what they're talking about and why it matters. So how does a rise in Treasury yields affect the economy? Well, it's a two-sided coin. On one hand, rising yields can be a sign of an improving economy. On the other, they can lead to higher borrowing costs, which can put a damper on economic growth. Let's break it down. Treasury yields are essentially the interest rate the US government pays to borrow money for different lengths of time. When the economy is doing well, investors feel more comfortable putting their money in riskier assets like stocks. This reduces the demand for treasuries, causing their prices to fall and yields to rise. So, in a way, rising yields can be viewed as a vote of confidence in the economy's health. But here's the flip side. When Treasury yields rise, borrowing becomes more expensive. Everything from mortgage rates to car loans to corporate debt is influenced by these yields. So as they rise, it becomes more costly for consumers and businesses to borrow. This can slow down spending and investment, which in turn can slow down economic growth. Rising yields can also impact the stock market. Higher borrowing costs can eat into corporate profits, which can cause stock prices to fall. We've seen this happen recently with big tech stocks, which are particularly sensitive to changes in interest rates. As yields climbed, investors sold off these stocks, leading to a sharp decline in the market. Moreover, rising yields can also affect the value of the dollar. Higher yields make dollar-denominated assets more attractive to investors, which can drive up the value of the dollar. This can make US exports more expensive, potentially leading to a trade deficit. In essence, the relationship between Treasury yields and the economy is complex and dynamic. Rising yields can be a sign of economic strength, but they can also trigger a chain of events that can slow down the economy and impact various sectors. The implications of rising Treasury yields are multifaceted and significant to the economy. The interplay between these factors is what makes understanding Treasury yields so crucial, and why their rise can cause a ripple effect across the globe. But what causes Treasury yields to rise? That's a good question, and to answer it, we need to look at a few key factors. Firstly, let's talk about inflation expectations. When the market anticipates a rise in inflation, investors demand higher yields to offset the decreased purchasing power of future interest payments. This is because inflation erodes the value of money over time. So if inflation is expected to increase, investors want more return on their investment to make up for that loss. Next, we have changes in monetary policy. The Federal Reserve, or the Fed, plays a significant role in Treasury yields. If the Fed decides to tighten its monetary policy, meaning it increases interest rates or reduces its asset purchases, it can lead to higher Treasury yields. This is because when the Fed raises interest rates, new bonds issued will carry higher interest rates, and existing bonds with lower interest rates become less attractive. Hence, to sell these less attractive bonds, their prices drop and their yields rise. Lastly, investor sentiment can impact Treasury yields. If investors are feeling bullish about the economy, they may move their money from bonds to stocks, which can offer higher returns. This shift in demand can cause bond prices to fall and yields to rise. Conversely, if investors are pessimistic about the future of the economy, they may move their money into bonds, causing bond prices to rise and yields to fall. It's important to note that these factors often interplay with one another. For instance, if the Fed signals that it's worried about inflation, this could affect investor sentiment, leading to a sell-off in bonds and a rise in yields. A variety of factors can drive Treasury yields, and keeping an eye on them can provide clues about future economic trends. So, understanding these dynamics can give you a better perspective on the financial market and the economy as a whole. What impact does rising Treasury yields have on different sectors of the economy? Let's delve into this intriguing question. In the sphere of housing, higher Treasury yields can make mortgage rates climb. This rise can potentially cool off the housing market, as higher borrowing costs may deter prospective homeowners. Now let's turn our gaze to the technology sector. Tech companies, particularly those in the growth stage, are often heavily reliant on borrowed capital. As Treasury yields rise, borrowing becomes more expensive, which can stymie growth and lead to a slump in tech stocks. This was evident in October when Wall Street saw a sharp decline in big tech and other growth stocks due to rising yields. But it's not all doom and gloom. The banking sector can actually benefit from rising yields. Banks make money from the spread between the interest they pay on deposits and the interest they earn from lending. When yields rise, this spread often widens, leading to increased profits for banks. This was seen when JP Morgan Chase reported better than expected profits, driven by rising borrowing costs. Rising yields can also lead to a rotation in the stock market from growth stocks to value stocks. Growth stocks are those of companies expected to grow at an above-average rate compared to other companies in the market. However, when yields rise, these stocks become less attractive, as the future cash flows of these companies are discounted at a higher rate. On the other hand, value stocks, which are shares of companies that are considered undervalued compared to their intrinsic value, can become more attractive. This is because these companies are often more stable and less reliant on borrowed capital, making them less susceptible to rising yields. In essence, rising Treasury yields can cause a shift in the market dynamics, impacting various sectors differently. So, here's what you need to remember about rising Treasury yields. Treasury yields, essentially the return on investment for US government debt, are a significant indicator of the overall state of the economy. When these yields rise, it indicates a range of factors, from inflation concerns to anticipated changes in Federal Reserve policy. The impact of rising yields on the economy is multifaceted. It influences borrowing costs, impacting both individuals and businesses. Higher yields mean higher interest rates, which can slow down economic growth as borrowing becomes more expensive. However, for savers and certain investors, higher interest rates can be beneficial. Factors driving the rise in Treasury yields include increased consumer spending, accelerated factory activity, and elevated inflation growth. These all contribute to the speculation that the Federal Reserve may tighten its monetary policy sooner than expected. Additionally, concerns about potential US government debt default and the anticipated tapering of Federal Reserve asset purchases also play a role. Rising yields don't affect all sectors of the economy equally. Technology and growth stocks often take a hit, as we've seen with the recent sell-off of big tech stocks. On the other hand, sectors like energy and utilities can rally, and bank shares may extend gains in anticipation of early monetary policy tightening. Understanding these dynamics can help you navigate the financial landscape. For example, the recent rise in yields has seen some pockets of the market gain, such as Merck and Amp Co. after the development of an oral antiviral medication for COVID-19, and Tesla Inc. following record quarterly deliveries. In conclusion, rising Treasury yields offer a mixed bag of implications. While they can signal potential economic challenges ahead, they can also present opportunities for savvy investors. Understanding Treasury yields and their impact on the economy can help investors make informed decisions. So keep an eye on those yields.